Ladies and gentlemen, a very warm welcome to you. And one word, help. Help. 1,000-point swing on Wall Street yesterday. Ukraine, Russia, inflation, Partygate, and I didn't know. Well, thankfully, in this Master Investor Forum, we have three panelists who do know. And over the next hour are going to help us look at the major themes and opportunities that lie ahead. They are all contributors to the Master Investor Forum and the Master Investor platform, and have CVs so extensive it would take a full hour for me to reference all their achievements. Joining me for the next hour are Victor Hill, Mark Watson-Mitchell and Jonathan Davies. A warm welcome to you all, and all of you watching on this platform and YouTube as well. So Victor, is volatility a theme of 2022? Has this month's stock market behavior set the template for the rest of the year?
Yes, I think so. I think that things will continue as they've begun. Thank you for your introduction, by the way, Sarah. I was asked to, just sketch out the main themes of 2022. And I said there's basically three strands which we need to look at. One is the macroeconomics, the background being one of inflation, which looks like it's going to persist. So the story about the transitory inflation that the central bank has tried to sell us last year doesn't really wash anymore. And you have combined with that, the prospect of increased interest rates. The Fed has signaled yesterday that the first hike will probably come in March. That has all kinds of structural impacts on markets. The second theme is really technology. Will the technology stocks bear up post-COVID? Will they continue to boom? They had a wonderful run during the coronavirus pandemic, but the tech universe may be about to change for reasons that I think we might have a chance to discuss. And the third main strand is, of course, geopolitics. And in particular, right at this moment, we have an extremely dangerous situation with Russia assembling an army on the borders of Ukraine, which might or might not cross over the frontier in the form of a full-scale invasion. Now, there are all kinds of ramifications of that, which we can discuss. But one of those is, what is the relationship between Russia and China? Have they actually put together a pact whereby Russia invades Ukraine and China seizes Taiwan at the same time? There are all kinds of nightmare scenarios out there. On the other hand, war is not inevitable, and this may be resolved in some kind of peace conference, which I think is what the Russians really want. Something, a new Helsinki agreement. You remember Helsinki was 1975, which set the diplomatic architecture for the next 25 years. So I guess, we can discuss these things. We're living in interesting times, as the Chinese say. All kinds of reasons to be cautious, particularly with regards to the equity markets. And I think, and I'm sure my fellow panelists will want to come back to this, one of the main questions is one of the keys to good investing in 2022 is asset allocation. And I think, we might want to discuss that further.
Well, thanks very much. I feel totally depressed now. So let's go to Mr. Sunshine, Mark Watson-Mitchell, because it sounds as though we're needing to follow a defensive play. I mean, inflation, nightmare scenarios. I mean, this month's trading for you. I had a sneaky peek at your portfolio, Mark, and are you factoring in inflation and the situation in the Ukraine when you are trading?
Right. Number one, I'm not trading. Okay, that's very important. Number two, I see inflation going to 10%. Absolutely, no doubt. You've only got to go round the supermarkets to work out the massive hike in prices, and goods are lowering in volume whilst their prices are going higher. And this is a way that manufacturers, obviously, and retailers have to cope with the situation. but I do see it going higher in inflation. Forget what the government says, in my view. You've only got to see the way that the Amazon vans aren't delivering as much as they were. At one time during the isolation period, we had vans going all over the place, and it was just phenomenal. And it was Sainsbury's, and it was Tesco's, and it was Morrison's delivering, and Amazon, of course. But now it's reduced massively. So I think, you know, sales are tempered. So going on Victor's point, yes, I see technology stocks lowering, and I find them very hard to value, and that we are led massively by the states, where they are just carried away on stupid valuations, in my view. I like value stocks. I like to see value in a balance sheet. I like to see levels of market anticipation. I like to see that the companies know where their market is, as opposed to guessing where their market is. That's why I like the annual recurring revenue stocks, because they know that their money is coming in month after month after month, year after year. And if they keep on building up the ARR, then they are going to create a lot of wealth inside their business.
Mark, so I do have to ask you something. You said that you're not trading. Had I used the wrong word, or do you take January off? Because you just mentioned
I don't trade.
Right.
I don't trade.
Okay, so the annual recurring revenue stocks that you've just referenced there, are you able to give us an insight into which ones you think are attractive?
Well, I mean, I love Cape Technologies. I mean, that's controlled by Teddy Zaghi, and it's Cypriot Israeli. And he is a very, very, very shrewd man, a billionaire, and he's even increased his stake in his own business. I think it's up to about 54% now. You don't get many people doing that. And they've made a massive acquisition late last year, which I think is going to be absolutely superb. Other stocks I like, Get Busy, which is a lovely old favorite of mine. They've got a very good ARR rate. But then I also come down to, if you want to know what other sectors I like.
Just one more, and then I'm going to
bring
put Jonathan in, because so one more, and then I'm going to talk to Jonathan about history repeating itself.
Okay, Central NIC, Central NIC. They're the people that have control on a lot of our internet domains, and they know. I think they run at 99% annual recurring revenue. Oh, bloody hell! I knew where my money was coming in every time. Anyway,
so that is a technology stock, particularly as it's probably controlling our lives in terms of our shop
very
windows.
Good, yeah.
And what,
but it's a good value stock, not one of these sky high 50 to 80 to 100, 200 times PEs. You know, this one's much, much more reasonable.
Okay, so I've marked its card, but Jonathan, just listening to the scene setters that Mark and Victor have established, you know, you've written for all the big broadsheets and Market Week, and you're on investment panels, and you understand about unit trusts, which I don't. But a lot of these themes in terms of inflation and attrition and conflict, they are recurring. So surely we should be able to predict trading themes. 2022 might not be that different a year.
Well, thank you. I'd start from a slightly different position, I have to say. I mean, I've been around a long time, like my fellow panelists, and lived through a lot of bull and bear markets. And I always start each year with not with predictions, but with a sense of humility, because quite often whatever we say is going to happen doesn't happen. And that has been the kind of one of the main lessons that I've taken away from 40 years of following these things. I also don't primarily invest in individual stocks. I primarily invest in investment trusts, which I think are the best way to invest in. If you're going to use managed funds, they have a superior track record for a number of reasons to open-ended funds like unit trusts. So I don't invest in many open-ended funds. So my specialty area is investment trusts, and some different criteria apply when thinking about the future. So essentially, I am already putting my faith in some of the people who I've invested with. That's by definition what you do if you invest in actively managed funds. And so I listen a lot to what they're saying, and I try to form my judgments on the basis of that. But I think the key point that I would make here is that this year does look like it's going to be slightly different from the ones we've had for the last, for a number of years. I mean, I always start by looking at a very simple chart, which is the US 10-year bond yield. And remarkably, it has been going down for almost the entire time of my professional career. And yet it's never yet broken out of the down channel over the last 20, 30 years. And when that happens, then I will be confident there's a regime change. I'm not sure there is going to be a big regime change, and notwithstanding the fact that we've got high inflation and bond yields are going up, interest rates are going up. What I do think that means is there's going to be volatility this year, undoubtedly, while the investors try to make sense of all these different things that are going on. And it's not surprising we've seen volatility already. And I would be personally, at some point we'll get on to saying, I think, not what do you think, but what are you doing, which I think is always the question well worth asking. And I've become pretty negative, but I'm not trying to make choices about things I don't know the answer to. So I don't know whether the Russians are going to invade Ukraine. I know it's a risk, but I don't know what the outcome is. I certainly don't know where we're going to end next year in terms of interest rates and inflation. I wish I did, but I don't spend my time looking at that. It's a difficult thing to get right, as we know. And in particular, we don't know whether the Federal Reserve, which has put itself on a course to tighten monetary policy, is in fact going to run away if the markets go bad, like they've done several times before. So there's an awful lot of uncertainty out there, and I am therefore taking a more cautious approach, and I've sold quite a lot of things and gone into cash and more defensive investments. So I'm waiting to see how this pans out. I'm not going to try and call all these extraordinary risks and variables that are out there.
Can you expand a little bit more? I mean, you just said there, the question that we should be asking is, right, so what are you doing? And you've given me a very broad brush answer that you've sold out and you're going into cash, but can you be a bit more specific?
Yes, I mean, I haven't done that. I've only done that once before in the last 20 years, and that was in 2007, where I was very lucky because I actually had a conversation with a member of the Bank of England managing board, and they told me that they, for the first time, had no idea what was going to happen during the financial crisis that was coming along. And if they didn't know, then I certainly didn't know, and I took some defensive action. The reason I'm doing that now is slightly different, because we have been in this extraordinary period since the global financial crisis where, as I said, bond yields have been falling. We've had extraordinary monetary stimulus, and that is coming to an end. And so we don't know quite whether it's going to be dramatic or whether it's going to be relatively, spread over a number of years. But my view is that I'm not, having made significant gains over the last 10 years by being essentially invested in growth stocks and growth trusts, I'm not confident that's going to continue. And so I'm basically, I've sort of taken off my big growth bias bets, and I put some value stocks in there, or value trusts in there, I should say. And I've got a lot of cash because I'm waiting to see. I think this is going to be it could well be a pivotal year. And I'm not prepared to put it, at risk a lot of the money that I've made by being, fortunately well positioned over the last 10 years.
So, Victor, what are you doing? How are you positioning yourself?
Well, if I can just pick up a point made by Mark and one by Jonathan. Technology stocks, we all know they've had a phenomenal run, and particularly in the last 2 years during the pandemic. Now, these stocks have been around in some cases for a relatively short time. So if you take Facebook, it was only incorporated in 2003. That's less than 20 years ago, and then it floated a couple of years later. Now, these social media companies have only existed in a world of near zero interest rates for most of their existences. And furthermore, they've profited from, this extraordinary amount of QE, the printing of money by the central banks worldwide, which has pushed up asset prices overall. So it's quite possible, even, given Mark's point about the absence of the Amazon vans, it's quite possible that these technology stocks are riding for a fall in a world of rising interest rates. Now, we don't know what the rates are going to be by the end of this year or by the end of next year. Few people think that interest rates in the US or the UK will be much above 2% by next year. We think that there'll be very minor incremental increases, possibly as many as 7 this year. But you're still looking at historically low levels of interest rates this year and next. But the overall trend line looks to be that there might be a reversion to a more historically normal level of interest rates. And so looking ahead, somebody commented on the screen, are we going to look at medium to long-term investment prospects? I think we might well be at a turning point where interest rates are heading back up to normality. So, when I was working in hedge funds, the risk-free rate was always, considered to be 5% because that was the long-term average of the yield on, as Jonathan mentioned, on yield on 10-year treasuries. And of course, we then went through a historically highly abnormal period when the risk-free rate effectively went to 0. So what I'm not doing is allocating to big cap stocks, and particularly to big cap technology stocks. And remember, Apple is 7% of the Nasdaq. So if Apple were to take a hit, which I'm not saying it's going to do, but it could be affected by the crunch in global supply lines and the lack of microprocessors, or in the scenario which I alluded to earlier, if China were to take Taiwan, the global supply of microprocessors would be disrupted quite extraordinarily. So that kind of event would have a massive impact on the likes of Apple, and that in turn would affect the market as a whole. So if you're allocated to index funds, you have to be cautious there. So I'm not allocating to these large cap tech entities. In fact, I would tend to want to stay clear of them. I mean, Apple has been a one-way bet for so long. I just think that could change. And I'm just interested in reducing equity exposure, not necessarily in favor of bonds, which are not necessarily, obviously as interest rates rise, so the relative attractiveness of bonds increases. But I'm very interested in things like, Jonathan would no doubt be able to make some recommendations in this space. For example, agricultural land funds, trusts which are looking at agricultural commodities, which are very much on the up right now. One of the sources of inflation, which I don't think has fully fed through into the system as yet, is increases in food prices. Agricultural commodities are heading up all over, and shortages of rare metals, of fundamental components for EV battery production like nickel and lithium. All these things are heading north. So I would say look at commodities, look at agriculture, look at land. I don't really have a view on property outside of the UK market, but I think that commercial property is under downward pressure with the long-term trend towards working at home, which has been accelerated by the pandemic. I'm quite bullish on some niche technologies. I mentioned well, in fact, one thing I'm quite interested in the pharmaceutical sector is that you know, the demand for vaccines, and not just for COVID or coronavirus, but for other potentially problematic viruses, is going to increase, and we might find ourselves in a situation where we have to have booster jabs at least once a year, if not more frequently. So those vaccine manufacturers, of which, you know, obviously Pfizer, BioNTech, and so forth, are preeminent. Moderna, Gilead is an interesting one. They haven't done so very well because their so-called antiviral medication hasn't really been vindicated during the pandemic. But there are other producers of equivalent medications. Plus the fact that a few of the pharmaceutical companies, Johnson & Johnson, are working on vaccines which are nasally administered, which actually would be much more practical, just particularly in the context of the third world, where it's actually very difficult to administer the Pfizer-BioNTech vaccine because it has to be held in cold storage. It has a short shelf life, and often you have to administer these vaccines in remote locations. So I'm very bullish on niche pharmaceuticals, and cybersecurity, I think, is a hugely important field, albeit that some of the players in this space haven't done as well as we might have hoped. Dark trace is one point in question. I think you follow that, Mark, don't you?
No, thankfully.
Yeah, there's a lot for us to deconstruct there, but let's
Yes.
go back to something you mentioned 2 or 3 minutes ago, which was about the supply chain. Now, Mark, in terms of companies that rely on components, wood, supply chain bits, semiconductors, do we avoid the companies that are component reliant on third parties, or do we be patient as we wait for their containers to arrive?
You're asking me. Okay, my reaction is that the market has already assessed these situations, and we start to actually put in values now, taking an 18-month view that the supply chains will get better, that delivery will be that much better. For instance, I like one particular stock in the delivery sector, Wincanton. Absolutely fabulous company. And they work for practically every major retail group across the country. And the profits are going to go 47 million last year, 56 million this year, 62 million, and then 70 million. Oh, I love that. You know, this is value, absolutely cracking value. And it's giving a good dividend. And the shares are currently about 350. I love it, absolutely love it. So, you know, that's the type of stock I like. And you were already talking about Smith's news earlier on, but perhaps we'll go on to that later on.
Talk to us about Smiths now. Talk, because you,
all right,
you and I were speaking about Smiths in the green room, and the people watching weren't party to that.
Okay, Smiths is a cracking situation. It is, okay, I'm expecting the company to make about 9.8 to 10 pence per share in earnings in this current year, and that's to the end of August. The shares are currently 35p. Oh, that's value. Okay, they're in a market. This company has got 55% of the distribution of newspapers and magazines in the UK. John Mentors does the other bit. But 55% is a cracking market hold. They've got contracts with the major publishers going 3-4 years ahead, which is what they have to do. Historically, they had a bad situation and basically a knackered balance sheet. They're correcting that. They have now done a refinancing with their financiers and funding sources, and they are now being able to lift up the amount that they can pay in dividend. Dividend, it's about 5%, something stupid. I mean, it's, you know, Victor was talking about interest rates. This stock, this has got value, this has got low earnings, and every day we can see what they're doing. Okay, they may not be making desperately large inroads into increasing their turnover. They turn over about $1 billion a year, and this is a little company valued at 86 million. Okay, they've got a lot of debt, but that debt is already catered for, and now they can actually lift up the amount of money they pay in dividend. In about 10 days' time, they're paying 1.5p a share to their shareholders. And if you read our article, you'd have actually got a 30% return on your money if you bought them 2 weeks ago and you sell out after. I'm not telling you to sell out, but if you have actually held them over the payment of the dividend, it's almost a 30% return inside a month. You don't get many stocks like that. Anyway, so that's Smith's. I just think it's a cracker. It's not necessarily going to make a lot of money in profits, but those profits on, what is it, 3.5, 4 times earnings? Well, you know, goodness sake, this is something we can actually feel. The things that I like to be able to go across the country and visit factories and look at and meet companies and see what the products are and what the services are. And Smith's, we have it every day. We know what they do. We can actually see it. Now, this is not WH Smith, but Smith's News, the distribution side.
Yeah, I'm interested about you talking about the visiting meat factories, because Victor passed the baton on to Jonathan earlier to talk about whether what value was in agricultural funds, for example. So meat, clean meat, agricultural funds. Jonathan, have they come across your horizon?
The honest answer to that is basically no. I don't, because there's number of things you can invest in a specialist way in the investment trust world, and there have been some very interesting opportunities over the last year, which I think about. But in fact, it's one of the areas where I think you can't get direct exposure to that directly to agriculture. You can obviously, there are trusts that invest in commodities more generally and invest in property and land and so on. But no, there's nothing specifically geared to agriculture and land at this point.
So you have an interest, a keen interest. You edit a book on unit trusts. So investment trusts, and how do we get involved in that? First of all, you've got to learn the title of the book first if you're the hostess. But how do we get involved? How easy is it compared to, you know, there's a lot of people watching who are only familiar with equity investing, for example.
Okay, so well, the book is called The Investment Trust Handbook. I produce it every year, and it's basically a mixture of useful data and series of perspectives on the markets overall and where the opportunities might lie in the investment trust area. I mean, investment trusts, for those who don't know them, are essentially, they are equities. They're listed companies. You can buy them on the stock exchange just like any other company, and they have a distinctive feature, which is that they are, unlike a unit trust or any kind of open-ended OIC or any kind of open-ended fund, you know, or an index fund, they have a board of directors, and they're governed by company law and all the accounting requirements of listed companies. So they have superior corporate governance in most cases. The issue with the investment trusts, they're rather more sophisticated. You have to understand the concept of discounts and premiums, because they don't always trade. If you buy a unit trust, you know the value is going to be pretty close to the NAV all the time. If you buy an investment trust, you have to understand that at times they, because of supply and demand, they sell at a discount to net asset value, and other times they sell at a premium to net asset value. So you have to understand that. But they're very good vehicles for the long-term investor, which is the kind of audience that I take with, and they've delivered fantastic returns over the last 10, 12 years. and some very good trusts in there. Another feature of them being that you can find out the ones where the managers actually have significant shareholdings in their own trust that they're managing. Whereas with a unit trust, you very rarely find out whether the managers actually have got their own money where their mouth is, so to speak. So for all those reasons, they're very good things. The most interesting aspect of the investment trust world in the last 10 years has been the emergence of so-called alternative asset trusts. So these are things which are not just investing in equities, but are investing in more specialist areas. And so we've seen a lot of trusts come which are investing solely in renewable energy, for example, which have been very popular. A lot of specialist property trusts, which I've been buying a lot of in the last 12 months, which invest in niche parts of the property market, such as some of them invest in care homes and things like that. Others invest in accommodation for the homeless, which is now, as you probably know, it's now a legal requirement for local authorities to try and eliminate homelessness. And then there's been a very successful series of investment trusts investing in logistics, in all the big warehouses and distribution centers that the Amazons of this world have been using. So they've been very interesting. They mainly sell on a yield basis. They're not going to give you huge capital gains, but they typically target between about somewhere between 7 and 10% per annum annualized returns, with a high degree of security in many cases. A lot of them have inflation linking in their, for example, the property ones have inflation linking built into all their contracts and so on. So it's a different kind of investment. It's obviously not one if you're trying to chase huge capital gains over the course of a year. It's not the kind of thing you're going to want to invest in. But if you're interested in a slow and steady compounding with a high dividend yield, which I think is going to become more important, has been very much in demand over the last few years to get a yield of between typically 5, 6, 7%, which is without much risk. They're very attractive propositions, I think, in the current environment where we are, just to go back to the very beginning, just briefly, just to say, we are living through this period of what we call financial repression, where the level of interest rates is below the level of inflation and has been for a number of years. And it's going to stay that way for some time, I think, because, as we all know, governments can't afford to pay back all the debt they've taken on. So they're not going to be in a hurry to do that. So these kind of things are going to carry on looking attractive. They're not the only things that are interesting in the investment trust space. Obviously, there's lots of things which have delivered significant capital gains over the last 10 years, including, famously Scottish Mortgage, the Baillie Gifford Fund, which has really shot the lights out until the recent, style rotation in the market, and lots of others which have delivered very handsome returns in capital gains. So there's lots of opportunities out there, but it is a big but. If you think that we're going to carry on making 15% per annum compound over the next 10 years, as we have done over the last 10 years, I'm afraid I have to tell you, you have to think again. That isn't going to happen. And that's really one reason why I think if the regime is changing, you have to change your investment approach and maybe settle for something rather less ambitious than you might otherwise do. And
is your book available on Amazon?
It is. It's available from Amazon. It's available directly from the publishers. It's available from my website. It's published by Harriman House. Go to the Master Investor, not the Master Investor website, I think the Moneymakers Investment website, which is the one I run and have a little subscription newsletter there, money-makers.co. You can find out all about it there.
Okay, so you mentioned renewable energy, renewable generation. Victor Goldman Sachs projecting that renewable generation alone represents a $16 trillion investment opportunity, and their time frame is just up to 2030 alone. So you mentioned it right at the beginning of the webinar. So what more can you tell us that you've researched about?
Yeah, I mean, one of the great themes of the next 3 decades is going to be decarbonization, isn't it? It's almost something that eclipses everything else. How do we get from a fossil fuel-based economy to a renewable energy one with carbon net zero? Now, whether you believe, as I do, that in fact it's probably not feasible to get to net zero by 2050, at least without a major depression in standards of living, which will have political consequences, or whether you're a technological optimist, as apparently our Prime Minister is, and think that the solutions will be delivered along the way. The fact of the matter is that this is going to be one of the biggest areas of the world economy. That said, what's interesting, as far as I've been finding out, is that the power generators seem to have performed in share price terms much more disappointingly than other market participants. So the people who seem to perform best are the companies which produce the technologies, the components that drive renewable energy. So I was writing about this last week for the blog. And if you look at companies like Delta Electronics of Taiwan, which produce photovoltaic cells and arrays, they are where the returns are at, because their products are obviously in huge demand. Whereas the nitty-gritty of rolling out solar arrays and of laying cables and of hooking them up to the grid is actually a much more basic engineering process, and the companies involved in that don't seem to have done so well. I have a number of, let's say, questions rather than I'm not a skeptic in terms of climate change or renewable energy. I think we do have a major problem. The question is, how best do we confront it without necessarily impoverishing ourselves? And I just think that wind technology has been overhyped. For one thing, the carbon emissions associated with erecting these wind arrays and manufacturing them and maintaining them and then decommissioning them at the end of their economic lives has not really been factored into the equation. And without subsidy, let's face it, even now, wind power would not be economic, even though it is now a major contributor to our power grid in the UK. I think it's something like 25% overall. On EVs, well, that's the way it's going. Tesla is now $1 trillion company. In fact, it's reported record profits yesterday, and the share price fell. I think it was 9.37 this morning. It's still a massive operation, which is worth more than the next 5 or 6 automotive manufacturers combined. So it's an incredible story, considering that was only incorporated in 2005. It's just an unbelievable success story. But it's based on the idea that battery, and particularly lithium-ion battery technology, is going to be the most dominant technology for the rest of the century. And I think that is questionable. For one thing, it takes something like 45 tons of ore to generate or to refine the inputs in terms of lithium, nickel, and so forth, which are inputs in a basic EV battery. Again, the carbon emissions associated with these practices are not really considered. Plus, there are all kinds of other, issues associated with the fact that a lot of these elements are mined in countries with very poor labor standards, such as the Democratic Republic of Congo, which is some of which are quite scandalous. So I think hydrogen technology is going to be the one to watch in the next 10 years, and there might even be some technological breakthroughs announced in terms of green hydrogen generation in the next year or so. In fact, we're just beginning to see the rise of a pink hydrogen industry. Pink hydrogen is where you generate hydrogen through electrolysis. Basically, you run an electric current through water, which is H2O, but the current in question is generated by nuclear electricity. So, it's a form of hydrogen generation which does not involve any carbon emissions at all. So it's equivalent to green hydrogen. And there again, I'm quite bullish on nuclear. I think that we have to bite the bullet, and we have to accept that we are going to have a core nuclear production facility to run our grid, and that has to be beefed up. And the potential solution there is in terms of these so-called small modular reactors, which can actually be put together in a factory and then shipped out and deployed on site and connected to the grid. And we know that Rolls-Royce is a leader in this technology, and they've proven they can do it. The government is now seriously looking at this. The French have already started to roll out a program of small modular reactors, which are going to replace the first generation technology nuclear network. And by the way, the French, who are obviously leaders in nuclear power generation, have experienced quite a few health safety issues in the last few months, with 6 of their plants actually idle right now as they undergo maintenance. So Rolls-Royce, I think we should be watching very closely, and I think that's a very good story. Plus, they're obviously leaders in aero engines, and they've got some wonderful products coming on stream. They're working on hydrogen powered aircraft, which I wrote about last week. There are all kinds of engineering problems associated with that. Personally, I don't think hydrogen aviation is ever going to be feasible beyond short haul and probably smaller aircraft, but it will have its place.
Can I jump in here a second?
Yes, please. Jonathan, can I just very quickly mention the prospect of gigafactories in the UK producing batteries? British Volt, you will have noticed, has been given basically a check from the government, or it's promised a check from the government for 100 million to build this new gigafactory in Blyth up in Northumberland. Well, yeah, I think we need to be a little bit cautious about allocating public money to an entity that has no track record in actually generating a product. Thus far, there hasn't been a single British Volt battery produced. And I'm not criticizing. I'm not making a political point. I'm just saying that we have to be cautious that such projects can actually deliver. Sorry, Jonathan.
Not at all. I wanted to make a couple of points, really. One about renewable energy. One, there are actually 20 investment trusts in the renewable energy sector now. They've been a very big growth area. And the better ones, they all offer yields of between 5 and 7%, but they're not just, there's wind generators, there's solar power people. There's also, I think one of the more interesting ones, there's a couple of relatively new investment trusts, one of which invests in battery storage, and another one a couple which invest in energy efficiency, which of course is actually probably, I would argue, a slightly better way to look at investing into the carbon, zero carbon future, because energy efficiency has got to be a good part of what happens. And the problem with renewable energy, as you correctly point out, is that as soon as governments get involved and start throwing subsidies around, it actually, first of all, attracts a lot of capacity into the sector, driving down rates of return. And secondly, of course, it leads to distortions in the market as well. So just the fact that we can see this clear trend going out 20 years, we know the direction of travel. It doesn't necessarily mean you're going to make an awful lot of money out of investing in it if you're investing directly into the output, for example. So it's it's a slightly more complicated area than one would like to think. It would be nice if everybody was all putting their money into these things and helping to drive carbon emissions down. But it's definitely a good area to look at if you can find projects. I mean, the renewable energy trusts I mentioned, some of them trade on big premiums because there's so much in demand, but they're still offering a yield of 5% or so. But you've got to take the risk of losing a bit of capital over time because those premiums will erode. But it does tell you that the more professionals, a lot of these trusts are owned by wealth managers and investment institutions who are looking to increase their exposure to this kind of theme, but are struggling to find better ways of doing it than than through this particular means.
So 2022, tipping points, potential tripping points, 45 tons of ore. That was quite a fact check in terms of EVs and lithium. But there's a question come through from the audience. Mark, I'm going to ask you this. It's from Ashok, who says, are there sectors that perform well and poorly during particular months of the year? I mean, before we used to talk about sell in May and come back in September. I'm just not sure that that applies anymore.
No. Well, yes, seasonality. Yes, it's a good question. A very good question. I have to say, I have not done an analysis on it because the actual, the ramifications of doing that are really quite enormous. I only follow companies from $1 million to 500 million in market cap. It's a lot of companies, and to try and analyze the seasonality in that, I wouldn't be sleeping. So it's a good question. I can't really help.
That's okay, but you can tell us what else you're looking at in this,
Okay.
in this first quarter.
Okay, well, we've already spoken about the rising oil and gas prices going on. That is currently, we're now looking at what could be $100 a barrel for oil. I mean, it's not that far away. And
90 today.
Exactly, absolutely right. So it is just a fraction of a few dollars away. We've been there before, and I think we're going to go up there again soon, which actually brings me down to three little oil and gas stocks that I've recently featured on Master Investor. And they are i3 Energy, which has got some Canadian interests, and the one that we did earlier on this week, which is Europa Oil and Gas, which is on the Wrestle field in North Lincolnshire. And the third stock is IOG, and they're out in the bay, the Wash, and I think they won't be that long before they're actually producing gas, which is going to catch the market just at the right time because prices are going so much higher currently. So these are three little penny stocks. IOG is currently 34p. i3 Energy is 13.85 pence. And the other one, Europa Oil and Gas, it's now 2p. I mean, when I did it earlier on this week at 1.57. And the dealing volume this week in Europa Oil and Gas has been incredible. The daily average of 1.3 million shares traded was exceeded the day that I profiled it. I think 8.9 million that day. And we've had unbelievable levels of dealing volume subsequently. People are now beginning to realize that the sellers in that stock have been taken out and that their potential is massive. I think one of the brokers is actually valuing the stock at 7p a share, and they're currently 2p. I think it's very interesting. Three little penny stocks, three little oil stocks, and I love it. Elsewhere, what do I like?
I'm just thinking, there's a couple of questions come in, but hold that thought because you might be anticipating some of the questions that have come through. Because we're hearing a little bit of white mechanical noise in the background of this webinar, which leads me into two questions that we've got. Are there the reported potential problems with 5G temporary? Because we know that some of the airlines, particularly in the US, are saying don't roll out the 5G. It will impact the safety of the airline industry. So that's one, the 5G, any problems with that? And then we have got what is your view on drone technology use as air taxis, and also the companies that would benefit in the manufacture and the air traffic management of these drones? So 2 tech-related questions. It doesn't have to be stock specific, but are any of you, do you have any views on the 5G conundrum and drones in authorized and unauthorized zones?
That's got to be Victor.
Well, you know, I've been writing about flying taxis for a couple of years now. I think it's a wonderful opportunity, and I think it's viable. And there are quite a few players in this space already, and quite a few designs. I can refer you to an article I did about a year ago, which had a number of links to these various designs and manufacturers. Basically, the technology is already there. You can launch these things into the air, and they will take you, at the moment with a pilot, to your destination, which might be up to, say, 60 miles away, and in a very convenient and efficient way. And they are electric powered, so there are no carbon emissions. And they're already, the German railway company is rolling out these sort of launch pods on the roofs of German railway stations in anticipation that these machines will be flying quite in the very short term. So there's an awful lot going on there. There will be an Uber of the skies, and I don't doubt that Uber and the other ride-hailing apps will be in on this, so that you, instead of just getting having the option to be driven across town, you'll have the option to get a flying taxi there as well. Of course, there are logistical issues about, you know, you have to have an appropriate landing pod and so forth. So I think we're going to hear an awful lot about that. It also would have the welcome effect of taking traffic off the road, which can only be a good thing. So yeah, I mean, drones are fundamental now in the defense industry. And as you know, a whole number of specialist producers have emerged. The Israelis seem to have a particular advantage in this sector. And they've produced some extraordinary machines, which are, you know, prowling over the skies of the Eastern Mediterranean in all kinds of capacities. So, you know, I think drones are just a revolutionary technology. On 5G, I can't claim to be an expert, but what I do know is that 5G is not just one thing. It's not just a function of the frequency on which you transmit. It's a cluster of different technologies, which when bundled together, give you much increased performance in terms of data transmissibility. So I would have thought that the engineers could sort this out. And I can't really understand why the telecoms operators didn't consult with the airlines in the US before. I mean, it seems very curious to me. They're obviously not talking to one another. It seems to be like a breakdown in communications. But
Okay.
In principle, it's soluble.
Very good. Now, we did start off talking about inflation and interest rates. Another question from the audience. Do you expect the banks to outperform in a rising interest rate environment? Will positive margins on borrowing exceed likely write-offs from increasing bad debts?
I think the answer to that is probably yes. It should be yes. It depends, of course, on the yield curve. In other words, whether the relationship between short-term interest rates and longer-term interest rates. But if it remains a positive yield curve, then yes, I would expect the banks to outperform. Indeed, one of the things that I've put some money into recently is an investment trust called Polar Capital Global Financials, which is basically a way to play this particular idea that the banks will do well. I mean, the banks are terrible businesses to invest in normally. You know, you only have to listen to Terry Smith talking about the banks, and you don't actually know much about what's going on. Their accounts are opaque, but it's undoubtedly the case that they are in much better shape than they were 10 years ago. And everybody who did get, got sucked into the great banking boom before the financial crisis has had to pay a heavy price if they've gone on holding those shares since. Despite having some quite good-looking yields in many cases, they have been terrible performers. But in this environment, if it is a change in regime, yes, of course, they're going to do very well. And I think it'll be a good thing to stick some of those into your portfolio, even if you have to hold your nose to do so.
So you keep talking about changing the regime. What exactly are you talking about? Are you talking about the political situation in the US and the UK? Are we talking about Boris and waiting for Mr. Gray's report?
No, I'm not spending any time worrying about that. I don't think that's going to have much impact on the market, whatever your views about it. I don't think much about politics. I mean, very occasionally it will have an impact, but it's not the most important thing. Geopolitics, another matter. I mean, invasion of Ukraine or Chinese invading Taiwan, yes, of course, that's a massive concern. And if that happens, you would see a flight out of all risk assets. Of course, you would. But no, not in the, frankly, whether Boris goes or stays, I don't think that's going to make a huge difference to the performance. It's interesting, though, that to note that the pound has been going up ever since that he ran into problems. So maybe the currency traders think it will be a good thing if he does go. But no, this is just a simple matter of economics. I mean, the banks do well when the yield curve is positive and interest rates are rising. That's everybody knows that, and that's why you can be fairly certain it will happen. And but when I say regime change, what I'm talking about is a change in the inflation, growth, and interest rate environment, which I'd say I'm not yet convinced that we've actually broken out of this long down channel that we've been in with bond yields. But if we have, that would be regime changes for investors, and that would be very positive for the banks.
Okay, Mark, I'm going to let you have the final word because I have cut you short 3 times, and you were about to tell us about there was 1 or 2 more stocks that you were paying attention to.
Oh, there are so many. So what have I got? Yes, I like the building supply sector. Stocks I like are Alimask, Brickability, and Speedy Hire. Those 3 very good companies. Alimask got their figures out shortly. Brickability had them out, I think, a week or so ago. At 3 very interesting companies. Elsewhere, I like the property sector. One of my favorites is Inland Homes, which is massively undervalued. I think it's about half the real value. And their shares are currently, there are 53p. I think they're at least 65, 70p. They've got their figures coming out very shortly, but it's the actual ability of that company to use other people's money to develop all of their brownfield properties. And they are expert at this business. They haven't lost 1 application for a brownfield development. And that is really quite impressive. And that's over 20 years. Helical,
10 seconds left, Mark.
Okay, whoops, there you go. Helical is a property business, a very solid company. They have just taken REIT status, or about to, for April next year, which means that they will be able to pay much more of their profits out in dividend, which is very encouraging. And finally, in that sector as well, Harworth, another company in the brownfield sector. That's Harworth Group.
Many thanks. Well, I'm glad. I'm glad that you're experts and that you're polymaths, because we touched on a lot of themes, micro and macro. Gentlemen, thank you very much indeed. Victor Hill, Mark Watson-Mitchell, and Jonathan Davis. We also want to thank Master Investor Chief Executive Tim Corcoran, who's a very hands-on chief executive. He's been operating the controls of this webinar today. But 2 things to tell you. Master Investor has launched its app, and you can read all the nuggets from all our panelists tonight. The content is amazing. And we have a full day of it on March the 19th. It's a Saturday. It's the UK's first real big investor show. It is at the Business Design Centre in London, March the 19th. It's a Saturday. We're all going to be there, plus some amazing guests and lots of companies who have been dying to see the whites of your eyes for so long. So we're going to go for 2022, a volatile year, but one where we'll be seeing each other in person again. Thank you very much, everybody. Thank you.